Back in 2018, when Donald Trump was president, he kicked off a trade war with China by raising tariffs, trying to fix trade imbalances. Fast forward to 2021, and after Joe Biden won the election, he kept the pressure on China by adding more tariffs and export controls, especially hitting the semiconductor industry. Now, with another US election coming up, Trump has said he's ready to start a new trade war and hit China with even higher tariffs if he gets back in office next year. But despite all the talk about trade wars, tariffs, and decoupling from China, the country seems to be doing pretty well. Last year, China's GDP grew by 5.2%, which was better than expected, even with a sluggish economy and a property crisis. So why haven't the trade war and tariffs seriously hurt China's economy? How has China managed to keep going strong despite all the sanctions and tariffs from the US? That's exactly what we're going to dive into in this video. But before we get started, make sure to subscribe to our channel to stay updated. Now let's get into why America is losing the trade war and how China plans to dodge future sanctions and tariffs from the US. China has built an unmatched supply chain ecosystem. Even though the US has been pushing to decouple from China, a lot of companies are still sticking with China for their production. So why is that? The answer lies in China's mastery of manufacturing. China has created a manufacturing ecosystem that's hard to beat. Let's take making a hoodie as an example. It's not just about getting the fabric and stitching it together. It's also about having easy access to all the little parts, like zippers, cords, dyes, and trims that are needed to complete the product. China's strategy has been to keep the entire supply chain within its borders, mastering each step along the way. They even import and process a huge chunk of the world's wool and cotton, including around 35% of the cotton grown in the US. This cotton is processed, turned into fabric, dyed, and then sewn into clothes and other products. These finished goods are then exported all over the world, including back to the US. The whole textile production ecosystem is based in China. And it's not just textiles. This is true for many other products as well. If a retailer in the US or Canada wanted to shift production out of China, they'd either have to move the entire ecosystem or still rely on Chinese inputs, shipping them to other countries like Bangladesh for final production. The costs of leaving China are just too high. As long as China maintains this manufacturing ecosystem, it will continue to dominate global manufacturing. Even with higher tariffs, many companies still find it cheaper to manufacture in China than anywhere else. Now, of course, this doesn't mean China will stay on top forever. In the coming years, as other Asian countries build up their own manufacturing ecosystems, the economic incentive to move production out of China will grow, but that's still a ways off. China's nearshoring shift. After the global pandemic, and with tensions between the US and China on the rise, nearshoring has become a hot topic in global production. Nearshoring is when a company moves its operations to a nearby country instead of a distant one. For Chinese companies, this strategy offers a big advantage. It helps them dodge the tariffs that the US has slapped on Chinese exports. Take, for example, what's happening in Mexico. In October 2023, the government of Nuevo León, a state close to the US border, announced that China's Lingong Machinery Group, which makes heavy construction equipment, is planning to invest $5 billion there, including building a new factory. Trina Solar also said it would put up to $1 billion into the same region. Then there's BYD Auto, which counts Warren Buffett's Berkshire Hathaway as an investor. BYD is looking at setting up a new assembly line in Mexico to sell cars locally and ship them to the US. China's investment in Mexico has seen a big jump, going from $38 million in 2011 to $386 million in 2021, before slipping to $282 million in 2022, still way above the usual. While China only accounts for about 1% of Mexico's foreign direct investment, it's now the fastest growing source of investment in the country. China is playing it smart. They know that if they want to keep and even grow their market share in the US after tariffs, they need to get closer to the US. And that's exactly what they're doing. This isn't just happening in Mexico either. China has been strengthening its ties with other Latin American countries like Ecuador, El Salvador, Brazil, Argentina, and Nicaragua. One of the biggest examples is the Belt and Road Initiative, with projects like Costco Shipping's $3 billion megaport in Peru, which will cut transit times between South America and Asia by 10 days. By nearshoring their manufacturing to countries like Mexico, Vietnam, or Malaysia, Chinese goods can bypass US tariffs altogether. This is a big reason why the US trade war against China hasn't been as effective as hoped. China is diversifying to emerging markets. With political tensions between the US and China on the rise, it doesn't look like things will calm down anytime soon, even with a new US leader coming in this year. The US has always been a key market for China's exports, but Chinese companies are starting to shift their focus. They're not putting all their eggs in the US basket anymore, and a big reason for this is the growth of emerging markets like the Middle East, ASEAN countries, and Africa. Over the past decade, ASEAN's trade with China has skyrocketed, more than doubling to hit $722 billion in 2022. This accounts for almost 1/5 of ASEAN's global trade. Since 2020, ASEAN and China have consistently been each other's largest trading partners. China's investments in the region have also seen a big boost, jumping to $15.4 billion in 2022, up from $9 billion in 2019 before the pandemic. China is ASEAN's biggest and fastest-growing source of imports. Between 2017 and 2022, ASEAN's imports from China surged by 70%, reaching $432 billion. Over 80% of these imports are industrial goods like electronics, machinery, chemicals, plastics, and aluminum. China plays a crucial role in supplying ASEAN's manufacturing, construction, and tech sectors with the materials they need. Most of the 10 Southeast Asian nations enjoy strong relations with China, with the exception of the Philippines. For example, Indonesia awarded China its first high-speed rail project, which is now up and running. Meanwhile, Thailand and Malaysia have expressed interest in joining BRICS, a move that would bring them closer to rising superpowers like China, India, and Russia. China's influence isn't just growing in Southeast Asia, though. Its presence in the Middle East is expanding too. Since becoming a net oil importer in 1993, China has relied heavily on the Middle East for its oil needs. By 2023, Saudi Arabia was China's second-largest oil supplier, accounting for 15% of its imports, just behind Russia. These energy ties have laid the foundation for strong and varied commercial relationships. In 2022 alone, trade between China and the Middle East reached $507 billion, doubling the figure from 2017 and growing faster than China's trade with other regions. All of this shows that the US is becoming less crucial to China as it ramps up trade with other emerging markets. As China keeps getting better at manufacturing, nearshoring, and building stronger trade ties with other emerging countries, it's becoming less vulnerable to economic sanctions and tariffs from the West, especially from the US. Do you agree with our take on this? Share your thoughts in the comments below. If you enjoyed this video, don't forget to hit the like button and subscribe to our channel for more.